Okay, so it is 2:01, so I will get it started. For today, it will be me presenting the webinar. Unfortunately, my usual companion, Hon Chontan, is on sick leave today. Nevertheless, we decided to keep going with the topic for today, given that it's a very important topic and we have a lot of interest in this webinar. So for those of you who are new to our webinar, you have the option to ask questions in the Q&A button that I will be answering them towards the end of the webinar. So let's get started. So why are we talking about managing intragroup financing in Asia? There is a couple of reasons for that. Number one is because intragroup financing, and particularly intragroup loans, is a very, very common transaction in the region. And that can involve a combination of inbound, outbound, or general intragroup financing arrangements in the form of cash pooling or guarantee fees. So we will be covering that today. The second reason is because it's a challenging transaction to price, because a lot of the times there is a big challenge to manage, which is making sure that whatever interest rate that is agreed is acceptable from lender country and borrower country. And I think the third reason why this topic is important is because we have a lot of focus on tax authorities on, in general, I will say, a trend in our region to either reduce the possibility of claiming interest deduction by limiting their interest deductions, or finding other ways such as debt equity ratios to also limit the amount of interest expenses that a company or a taxpayer can deduct in a particular country. So that's something that is really one of the latest trends and that we have to be aware of, because if there is some issues around deductibility, then a multinational group will think twice before entering into intragroup loan transactions. Before we get into the topic, let me just do a brief introduction for those who are new. This is just a general disclaimer that this presentation is for information purposes and it should not be taken as professional advice. So as some of you know, we are a firm that specializes in providing transfer pricing, consulting services, and advisory to multinational groups in the Asia Pacific region. We have 3 offices: Australia, Singapore, and Malaysia, from which we cater to clients in the Asia Pacific region. So we don't only limit to our particular countries, we also cover the region. Apart from that, we also do a lot of education efforts, from doing presentations with the government and the agreements of accounting bodies in the countries, and also contributing to journals. So, and now a lot of webinars that we have also created for everyone to access. So for those who don't know me, my name is Adriana Calderon. I'm the director and technical leader for our Asia business. I'm the co-founder of Transfer Pricing Solutions Asia and Malaysia. Before being part of Transfer Pricing Solutions, I have been working before in international tax and transfer pricing with Big 4 and mid-tier firms, advising multinational companies in the area of corporate and international taxation across South America, US, Australia, and the Asia Pacific region. Over the past 15 years, I have been practicing transfer pricing in the Asia Pacific region. So I hope I can bring some value to all of you and some tips on how to handle intragroup financing in Asia. So let's start with the topic and start thinking about some general considerations. So it is a bit of a high-risk transaction, the intragroup financing, because tax authorities have, as I was saying earlier, a big focus on making sure that deductions associated with financial transactions are reduced in general. So any financial transaction we have as an outcome potentially being an assessable income in one country and allowable or not allowable deduction in the other country. So that's the two sides of the coin that anyone will have to manage. Also, there is a very, very important topic which we'll be talking about today, which is the nature of the financial transaction and whether it is considered really a financial transaction or is more equity in nature. And that definition can have a big impact in the deduction side because for those who are not familiar or who are familiar, payments associated with contribution of equity are non-deductible and most likely to be dividend payments, whereas payments associated with loans or any other financial transaction most likely will be considered as a deductible expense. So that is a big difference between the two options that can affect the company tax position. And because of that, we have to bear in mind also the impact and the general tax rules associated with caps on interest deductions, such as thin capitalization rules or fixed ratios rules that limit the possibility of having a company that is highly leveraged or that has obtained a lot of loans, especially if they are all associated with related party transactions. So let's start looking into something that is very important, which is what's the typical debt structure of a company. Because once we understand this, then we understand where the loans sit and how do we go about it from tax and TP point of view. So generally, the debt structure of an entity will be divided between equity and debt. And in theory, in some countries, there is some, or I will say in all countries, there is some level of freedom of how much equity or debt I should put in my subsidiary entity or in my related party entity. So strictly speaking, if we put tax aside, there is somewhere freedom to decide the debt structure. But from tax point of view, there is some rules around sometimes how much of my company can be funded by equity and how much can be funded by debt. And the main reason for that is, as I was saying earlier, the possibility of deducting interest expenses associated with debt versus obviously dividend payments not being subject to deduction. So that's something to keep in mind because first, the debt to equity ratio is kind of free, but it's not free from tax point of view in a lot of countries. And the second thing is if I decide to do a lot of funding with debt, when pricing the intragroup loan, one has to take into consideration whether a debt is senior debt or junior debt, because depending on which one it is, I can have a lower or a higher interest rate because depending on which one I am, I can have a higher likelihood of default. So the seniority of the debt can also impact the interest expense in general. Junior debts are subordinated to senior debts, and because they are subordinated, they will be paid later. and because they will be paid later, then the likelihood of default is in theory high. So it is always very important when we are, for transfer pricing purposes, defining the nature of my instrument, to first define, is it equity, is it debt, and within debt, is it senior or is it junior? That can affect the way in which the interest rate should be set. So that's why I bring into the discussion today the Chevron case, more to be able to see in an example the typical challenges that one can face when it comes to setting intragroup loans, and what is it that the tax authorities are concerned about, and how can I manage those risks. So if we see the Chevron case, what we have is a situation whereby a company has a channel of funds that essentially start with an external borrowing of 2.5 billion USD borrowed at 1% to 2%. And that funding was raised in the US under this company called CFC. So CFC was used as a vehicle to then fund an Australian operation whereby CAHPL actually borrowed the same amount from CFC, but the intermediary or the on-lending rate was AUD LIBOR plus 4.14%, which was an equivalent of 9%. So if we think about it, the difference between the original lending rate and the ultimate lending rate was about 7%. So in theory, this intermediary entity was making around 7% extra interest rate for being an intermediary vehicle. And that's one of the biggest issues that tax authorities have a problem with, because when there is a lot of complicated channels of funding, the biggest challenge is always about, okay, is it allowed to do an on-lending rate, and how much of that on-lending am I allowed to put? And that has been one of the biggest debates when it comes to intercompany loans and funding structures. So let's see what were the 5 key challenges, and let's discuss in more detail how one can go about it. So usually the challenge number 1 is the substance of the loan. So as I was saying earlier, is the loan really a loan, or is it another type of instrument? Challenge number 2 is usually the value of the loan. So that comes down to my point earlier of, is the size of the loan in terms of value reasonable? Am I allowed to have that much of debt, not so much from corporate purposes, but more from tax purposes? The third challenge is usually how, once I know that the loan is in substance a loan, and that the value of the loan is something that is acceptable from the local tax authority point of view, the third question is, how do I price this loan? Then the fourth question is, do I need to consider the credit rating of the borrower to price this loan? And the fourth one is, would an independent party have entered into that loan and into that transaction? So once one resolves all these challenges, you will be in a very good position to defend your instrument and defend your interest deduction or your payment deduction, if that's your end goal or end goal strategy. So let's talk about first substance of the loans. And one has to understand that when it comes to loans and substance, it is something that I don't think a lot of companies pay too much attention, because sometimes companies believe, oh, it is just an intragroup loan. Why would I bother to pay so much attention to the contract if at the end of the day, it is all within the same group? And that's where the problem starts, because one of the first things that one has to present to a tax authority when it comes to an audit is a contract. And if the contract doesn't have the terms and conditions of a loan, then there is a very high chance that that will be the first reason for the tax authority to disregard the loan to be a loan. So for example, some key things that are very important to have in any contract is the presence of a fixed repayment date, the purpose of the debt, the existence of financial covenants and securities, the status of the funder in comparison with corporate creditors, whether it is subordinated or senior, the right to enforcement payment of principal and interest, the obligation to pay interest, and what happened if there is a failure of the borrower to repay it on the due date or to seek a postponement. So it's very important that in very simple terms, the contract has very clear terms on obligations to pay the principal or the capital and the interest rates. If I am not very clear about that, there is a very high chance that that instrument can be recharacterized as something else. Then we have that once we have the contract in place, the context in which we have to make sure that the loan is a loan is particularly in the context of domestic legislation where the borrower and the lender as well are located. So one needs to double check the domestic rules on definition of loans. We also have to check the rules on limit of interest deductions. And obviously, as you know, the hubs or the financial hubs, particularly in Asia, such as Singapore and even Hong Kong, are a little bit more flexible when it comes to thin capitalization rules, because obviously where a country that is a financial hub tend to not have so much limitation when it comes to debt and equity structures of companies to incentivize the free flow of funds. But countries where there is not financial hubs, such as, you know, Malaysia, Indonesia, India, Australia, Philippines, and the like in our region, will not have that flexibility, because obviously these countries tend to have a lot of subsidiaries, and those subsidiaries tend to have a lot of inbound loans. So if they don't put some limitations, their argument, or in theory, the concern of the tax authorities, that there is going to be a lot of tax leakages with a very high number of deductions. So that's why it's so important to always look at the domestic definition and making sure that a loan is really a loan, together with making sure that the contract is in substance a loan. So let's see an example of what I mean, so people understand like what is a loan versus what is not a loan. So let's assume that I have a company A that is a leading manufacturing company located in country A, and channels funds via equity and debt into a financing entity. And this financing entity is located in country B, which happens to be maybe at a lower tax. And then I have that this entity channels the funds via a loan, and maybe that loan is around 100 million at 8% interest, and it channels it down to company B, which happens to be in country C at a high tax. And the terms of the loan says that the tenor or the term is 100 years. There is no repayment clauses for principal, and company B is required to pay only if it makes a profit. Obviously, this is a bit of an extreme case, but the point here is if country C tries to review or audit this loan for company B, the chance, and company B has been deducting these interest expenses for several income years, there is a very high chance that the tax authority of country C will seek to recharacterize this loan as potentially equity contribution and disregard the possibility of deducting the interest expenses for a certain income years. Or if there is, like we said earlier, like the Chevron case, there is more of a on-lending situation where company A lends, let's say, at 3% to the finance entity, and then the finance entity on lends to company B at 8%, there will be a 5% spread in between that probably country C will also have an issue with and may try to think or argue on whether that on-lending rate is reasonable or not. Then we have that the third key thing is we talk about price and whether and how do I go about setting up the price. And one of the most common ways, if one has a low value loan that is not necessarily very material in the context of the country, borrower, and lender, one can use indicative rates. So the first question is, are indicative rates available in the country of the borrower? Because the first point of view is like, okay, if I'm a borrower that can lend from third parties like a bank, then, or in my own market, in my own country, what will be the interest rate that I will be paying to a third party if I was going to enter into a loan with a third party rather than my related party? Because if you think about it from a borrower point of view, it doesn't make sense to enter into an intercompany loan where I'm going to pay more interest rate than what I would pay to a bank. So that will be the first thing to look at. The second thing will be to make sure that whatever indicative rate that I'm using, if is available and it is allowed in the country of the borrower, whether is also allowed in the lender country. That's why a lot of the times, depending on the materiality of the loans, we end up doing transfer pricing analysis, because a lot of challenges can come here, such as maybe the country of the borrower or the lender don't have indicative interest rates, or which are like allowable to be used, or maybe I have it in the borrower and I don't have it in the lender. So that's why a lot of the times we end up with material, if the transaction is material, with transfer pricing analysis, because unfortunately there is not a common approach on indicative interest rates that one can say, okay, anyone in the region will abide to this. Even the OECD hasn't standardized this, like they have standardized, for example, the routine services markup. So because of that lack of standardization, we are always dealing with this challenge of lender country perspective and borrower country perspective. And obviously, we also have to take into consideration the currency, because usually the currency is the driver for any base rates that we're going to apply to it. So that's another consideration to keep in mind. Also, I will say that currencies in general, we can see a more standardized approach when it comes to the base rate, because if you have USD, you will have a particular type of base rate, or if you have SGD, you will have a particular type. And that is kind of standardized because the base rates for currencies are published worldwide. What is the challenge is more the additional margin that I add to my risk-free rate. So let's see an example so we can elaborate more on this point. Basically, let's assume that I have company A, which is a distributor of electronics and is located in US. And then I have company B located in Malaysia, and company A provides a loan of 13 million SGD to company B. So the question is, what indicative interest rate I should be looking at, and am I allowed to use one? So in this particular scenario, for example, I already have a big challenge because company B and Malaysia, which is located in Malaysia, Malaysia doesn't have indicative interest rates. So that is a bit of a challenge because you can have market rates published by the Reserve Bank of Malaysia, but there hasn't been a statement from IRB to say that for tax or TP purposes for them, that is a reasonable interest rate, like, for example, Singapore has done it. So I will have a big challenge here already because of that. Then the question is, does US has an indicative interest rate? And the answer is yes, they do have some guidance around accepting indicative interest rates that are published by the Federal Reserve. And they indicated specifically which ones are they willing to accept. And that can be something that can work from US point of view, but most likely is not going to work from Malaysia point of view. And if we consider 13 million SGD material, there is a chance that this loan will have to be benchmarked or analyzed in detail in a transfer pricing documentation. The other thing is whether company B can take such a big loan and can deduct whatever is the interest rate that is agreed with company A. Because in Malaysia, we have limitations on the interest rates that I can deduct. And because of those limitations, one needs to also understand what's the maximum allowable debt for company B and what is the maximum interest rate that company B should be can deduct from a tax point of view. So that brings me down to obviously the point of always looking or not disregarding or always taking into consideration the possibility of external debt as a good proxy for pricing intercompany loans. So if we see this example, I have a related party X located in country A, who is the lender, and a related party Y, that is the borrower, located in country B. So if the funding from related party X originates from a third-party bank, loan A, this interest rate is the obvious reference to set the intercompany loan between related X and Y. And that comes back to that Chevron case, which is the question will be more, can related party X add any on-lending margin in between? And that's basically what the related party X and Y will have to analyze in detail whether there is merits to add on an interest rate on top of the third party bank interest rate, under the assumption that there is a role that related party X is playing for serving as a funding vehicle. The second option, which is also always available, is the possibility of looking at any third-party bank that the borrower in country B has and using that as a reference for setting up the interest rate for the loan between X and Y, but that needs to be also looked at from the lender country point of view. So let's see, it's a little bit like this example. If we have a third-party bank that lends to a head office located in Germany, and that's 100 million, and the interest rate is LIBOR plus 1.5%, and then that's on lent to a Thai subsidiary. So the starting point will be the third-party bank interest rate, because Germany will not be also if we flip the coin, can Germany lend at a lower interest rate? And I will say that probably that will not be allowed, because if Germany is on lending the whole capital to the Thailand subsidiary, and it does it at a lower interest rate, then Germany will be bearing some part of the interest expense that is not getting a benefit for. So I will say that the starting point will always be the interest rate that I'm getting from the third-party bank. Then the third question is, what do I do if I don't have third-party debt, or if I have to go back and lend from equity? Or what happens if I want to on lend at a higher interest rate? And that's where we will have to go down the path of doing an analysis where we mainly have, or what we have observed is kind of two broad categories. One is the possibility of applying the comparable uncontrolled price, and that involves conducting searches for either intercompany independent loans, third-party loans, entering into the market in a particular industry, or looking at bond yield curves. And that's probably, especially when I'm funding from equity, that's the most common way to price intercompany loan. Or I could have, if I have third-party bank available, I could potentially use what is called the cost of funds, which is basically the borrowing cost incurred by the lender in raising the funds to lend, and I can add any expenses associated with arranging, plus, as I was saying earlier, an intermediary risk premium that needs to be substantiated properly. Or I could also, if I only have equity and I don't have debt, I could potentially determine the cost of fund of the group based on a proper finance model, whereby I can look at the qualitative and quantitative factors that can impact the price of my loan and determine the interest rate or the average cost of debt for my company in specific, and use that as the basis for any intragroup loans as well. That requires a little bit of understanding of finance structures within the group, and usually something that Treasury, I have observed, if the company has a Treasury team, they will be able to potentially do it. So as I was saying earlier, if you go down the path of doing external CAPs and external analysis, two key things you will have to look into. One is the credit rating analysis of the borrower, to be able to define what's the likelihood of the borrower defaulting. Two, I will have to go down the path of doing the benchmarking analysis of the interest rate. And as I was saying earlier, you can do it by looking at third-party loans or bond yield curves. You have to also look, as I was saying earlier, the fact that one has to make sure that the intercompany loan is supported by commercial reasons, that there is not a tax motive only associated with it, and that the borrower can be capitalized or can be funded by debt, and there is no limits on debt or equity. One thing to keep in mind is, as a general rule, we look at transfer pricing analysis at the time that we enter into the loan. And in theory, one shouldn't be looking at it again through the term of the loan, because it's very much like if I go and obtain a short-term or a long-term loan from a bank, and we agree of an interest rate today for 5 years, then I shouldn't be re-looking at it again. Having said that, at the moment, what we are observing is a lot of re-looking at interest rates of loans for two main reasons. One is the fact that the base rates have changed since last year. So we don't have any more like SIBORs and LIBORs. Now we have SORA and other type of base rates to price debt in general. So the risk-free rates have been basically changed by another base rate. So that's one reason why we have observed a lot of changes lately. And the second reason is the fact that interest rates have been going up since last year. So that's something to be very mindful of, because if I have a loan that was entered into 2018 or 17, and let's say is for 5 or 6 years, and I continue with the same interest rate, the tax authority could, if they have provisions in their particular country of the borrower, of the lender, to recharacterize transactions, there is a very high chance that they could argue, especially in the lender country, that anyone in the market would have renegotiate the loan if they know that the interest rates are going up, which is what most banks are doing. And because of that, the lender should have approached the borrower and renegotiate. So that's something to be very, very, very mindful of, to know if there is not enough reasons for keeping all loans with very low interest rates. It's better to start looking into it and potentially renegotiating and amending those contracts. So let's look next at cash pooling arrangements, because I think there is I have noticed an increase in cash pooling arrangements lately. And I think the reason why there has been a lot of increase in cash pooling is because cash pooling arrangements, if we take out the element of TP and tax, in theory, or like practically and commercially, cash pooling arrangements allowed any group to reduce potentially the external cost of debt or the general finance cost. So when interest rates, with the interest rates going up so rapidly over the past 2 years, there is obviously an interest of basically utilizing the cash within the group, among all the entities in the group, before trying to go down the path of doing external funding. So how cash pooling work is essentially, there is a master account global leader, which could be the HQ or could be a company sitting in a financial hub such as Singapore or Hong Kong. And that leader has kind of accounts for each of the subsidiaries, whereby each day one pulls the debt and credit balances to be able to reshuffle the cash among the entities of the group. So it's very simple. So if subsidiary one has a lot of cash, the idea is that that surplus cash can be used by another subsidiary that maybe is not cash rich. So that's the whole rationale behind cash pooling. So it's essentially a mechanism to optimize cash and liquidity. One can maintain the master account with the bank. Every cash pool participant maintains separate accounts, and the idea is that you balance each account every day to 0, or it could be maybe every week. So the cash can be transferred and reallocated to whoever has deficit in cash. And the key thing here is how the credit and debit balances in the accounts are remunerated by the arm's length interest rate, and how can I look into that. So I was saying earlier that a few core things. So the idea is that it will benefit the group because it minimizes the cost of funding. It improves the administration and centralization of treasury expertise. It centralizes the monitoring of cash position of the group, and it maximizes the group's return on cash, as better terms can be negotiated with bank, because as a group you have more cash available. So where does transfer pricing come into place here? Essentially because we will need to set an interest rate for the credit and debit balances, to be able to make sure that whoever is kind of depositing cash or receiving cash will have to pay some interest rate on the, whoever is receiving cash will have to pay some interest rates for kind of getting cash out of the pool, and whoever is depositing cash will also be having to receive some interest rate because he's giving up their cash. So that's where the interest, the arm's length interest rates come into place and transfer pricing come into place, because those two interest rates for the credit and debit balances will have to be set. And they will have to comply with the arm's length principle and with transfer pricing. Then the second point is, okay, do we also have to pay something to a cash pool leader for managing the cash pool and for potentially providing services? And what should be the methodology? So those are the three key aspects that one needs to keep in mind when it comes to cash pooling. One is the interest rate for credit and debit credit balances. Two, the interest rate for debit balances. And three, where the cash pool leader should be remunerated and how it should be remunerated. Then we have intragroup financial guarantees, where is also a very, very, very common transaction that involves essentially company B receiving a loan from a third-party bank, but that loan is guaranteed and is guaranteed potentially by head office. And when I receive that guarantee, I have to pay, whoever is benefiting from the financial guarantee will have to pay for the guarantee fee. Now, why this has been a bit contentious over the past years is because a lot of the times there was doubts on whether there was a financial guarantee being obtained just for the fact that company B is part of the group and company A, which potentially has a stronger balance sheet, is allowing for the company B to obtain the loan. So that has been discussed extensively. And the first thing that we have is that one needs to address whether the guarantee is chargeable. And if it's chargeable, then we can discuss what is the arm's length fee for the guarantee fee. If it's not chargeable, then obviously there is no guarantee fee, even if I do a payment. So what has happened before, a couple of court cases that had happened, is that maybe this financial guarantee was not explicit. And even though it was not explicit, company B was paying a guarantee fee here, under the argument that there was an implicit financial guarantee for being part of the group. Now, that has been ironed out a lot. So the current acceptable, I will say, view is that any financial guarantee for being to be chargeable and deductible needs to be explicit. In other words, the head office needs to explicitly agree with the bank that they're providing a financial guarantee, and then it can be chargeable. These days, if you don't have an explicit guarantee from head office to the bank, and you're still paying a guarantee fee, there is a very high chance that this fee can be rejected as deductible, because under the argument that is not chargeable because it's non-existent, because it's not explicit. Once we iron out the fact that it is explicit, then the question is, how do I set up the price for the guarantee fee? And for that, we have the possibility of talking about internal caps. If there is other guarantee fees within the group that have been paid to banks, or if I can look at any external guarantees being entered between a bank and external parties, and using that percentage as the best proxy for the guarantee fee market rate. The second option is to do an external cap by doing a cost and benefit analysis, whereby I kind of assess how much benefit am I obtaining from getting the guarantee. In other words, what's the reduced interest rate that I'm getting from obtaining a guarantee fee, and then splitting that benefit as the guarantee fee. There is other ways, such as using commitment fees as a best proxy, or financial guarantees for insurance as a second proxy. So that's essentially what we have for today in terms of financing in Asia. These are the most common avenues of financing. My take is that cash poolings probably will be an emerging funding vehicle that will keep coming, mainly because of the need of companies in general and multinational companies to reduce the general cost of lending, given that interest rates are going so high. So everyone probably is going to try to utilize their cash as much as they can. So just to wrap up, 4 key tips. First, always understand what's the tax risk. Is it income or expense for the taxpayer that is under review? Can I have internal caps in the form of internal rates offered by banks within my group? Always check the limitation in interest deductions and think capitalization rules as well for the countries involved. And as I was saying earlier, very attractive, the viability of cash pooling to reduce cost of debt. And remember always that even though your interest rate is an arm's length, it doesn't necessarily guarantee that you're going to have a deduction under general tax, because you will also have to consider your domestic tax provisions in this respect. So with that, let me just move to questions, which I can see that there is a lot in the Q&A. So let us look into this. Okay. Let me start here. For domestic loans, if SG parent company has excess cash to provide interest-free loans to SG subsidiaries, is there a risk that IRS will deem interest income for parent company? There is no interest expense to restrict, as subsidiary code does not incur any interest expense. Loan is not capitalized as equity for easier repatriation of funds. Oh, if only I had a coin for every time that people ask about interest-free loans. I always come to these questions on interest-free loans from a substance point of view. And the reason I look at this from a substance point of view is because at least this question is in the context of Singapore. Singapore IRS has the possibility to recharacterize transactions. And if they believe that something is not what it should be, then they can recharacterize. So that's my concern always of interest-free loans, that the concept of interest-free loan has always been associated with 2 key aspects. One is the quasi-equity position, which is I fund my business, and the only reason I'm doing it through a loan is to facilitate the repatriation of funds, but that business has no ability to borrow. And that could be an argument for my interest-free. But on the other side of the coin, what I think we can not be complacent with is the fact that if I have a loan that should be a loan and is in substance a loan, why am I calling it interest-free? So I come back to the substance. If your loan is really a loan and your subsidiaries have the ability to borrow and have cash liquidity to service the loan, then it should be interest bearing. It shouldn't be an interest free. And this is a common situation where everyone always, oh, why don't you just do it interest free? I know this is in the context of Singapore, within Singapore. So to some extent, one can say that maybe it's a lesser of a risk, but the point here is that IRAS has never taken a statement to say that they accept interest-free loans that are interest-bearing. Their point is always, if it's interest-bearing, it should be interest-bearing. So that's how I want you to understand the question of, is it okay or not? Well, if it is in substance alone, then it's not okay. If it is in substance not alone, then maybe it's okay, but you need to explain that why it's not in substance alone. I hope that helps. How to determine if a loan amount is reasonable or allowable? What tax considerations are there depending on the value of the loan? I think that's a very good question, because the starting point for that question has to be always your debt and equity ratio, and looking at what is the debt and equity ratio allowable in your country. After you know what is the debt and equity ratio, and if there is limitations, then there is information publicly available that shows what is the debt or equity ratio of companies by industry. And if you don't have a limitation, that could be another proxy. Is the difference between debt and equity and loan the presence of absence of interest payment? Not always. There could be other reasons. One needs to double check. Most countries have a very clear definition of what is loan and what is not loan, and how to define hybrid instruments. So you will have to look at the factors in your particular country to make a call whether it is debt or equity. Presence or absence of interest payment is one consideration, but it's not all. That depends on your country, basically. Can local safe harbor rules, if provide any guidance in relation to intra-group loans, be taken into consideration for deciding the interest rate? We covered this in one of the other slides, where I explained that you can, but you need to make sure that it's acceptable from borrower and lender perspective. And that can be sometimes a challenge. So that's what you have to look into. If there is explicit guarantee but parent company is not charging guarantee fees, will IRS deem a guarantee fee income on the parent company? Yes, that could be an issue. If there is explicit guarantee and you're not charging for it, whoever is providing the service, the tax authority, that's a really good question. Whoever is providing the guarantee could be challenged that it should have a guarantee fee payment for it, if the benefit is material. With the rising interest rates in Malaysia and Singapore, many companies are considering converting debts into equity to save interest costs. What is the transfer pricing impact on this from Malaysia and Singapore? Well, if you convert debt into equity, I guess the question is, what are you going to do with the debt? Are you going to settle the outstanding interest and capitalize only the capital, or are you going to capitalize the interest and the expense? I think that's what you need to keep into consideration, how you're going to do it in the moment that you convert it. And then once you convert it into equity, then there is no argument anymore, in the sense that you have clearly converted from debt into equity, and you have treated properly both the capital and the outstanding interest. So I think as long as you do it properly, and then if you're converting the capital into equity, then you should have a proper explanation as to why you decided to take that decision. So I guess the concern is, would the lender country have the possibility to say that conversion is incorrect? I will say no, unless I will say no, but you have to do it properly, in the sense that don't give rise to, for example, foregoing interest and all of that. I think that will be the argument and the problem. If you kind of forgive interest and things like that, that's where the problem starts. We usually share the recordings, not the slides. Okay, so someone is asking here, last question, can the payment of outstanding debt or payment on behalf be considered a loan? Outstanding debt is a loan. I don't know if you're talking more about like outstanding trade receivables or non-trade, but in general, yes, anything in theory, anything that is outstanding beyond my trading terms is considered a loan and should attract interest. Okay. So with that, we're done for our webinar for today. If you want to contact any of our staff, we have our details at the end. We do these webinars with no cost, but all we ask is for people to like us and subscribe to our YouTube channel. There is a lot happening in July, so we have another exciting session next week, which is going to be about the new changes or the milestone changes to the Malaysian transfer pricing landscape. We will be talking then at the end of July about managing intragroup services in Malaysia. And then we will discuss in August profit splits versus traditional methods, mainly because there is an influx of decision around whether one wants to apply profit split or traditional methods. So we will see about that in August. Here are all our details. Feel free to reach us in any of these emails to any of our staff for help, and like us in all our social media channels. We are everywhere: Instagram, LinkedIn, Twitter, Facebook, Google+, YouTube. So please keep liking everything in all our social media channels. Thank you everyone for joining today, and we look forward to seeing you next week in our next webinar.